Unlocking the secrets of millionaire investing books requires far more than memorizing strategies, formulas, or portfolio allocations. It demands understanding the psychological frameworks, mental models, decision-making philosophies, and structural advantages that the wealthy cultivate almost instinctively. Millionaire investing books are often misinterpreted as manuals on where to put money, but their true power lies in reshaping how investors think about risk, reward, time, behavior, and opportunity. These books reveal not merely what rich investors do, but how they see the world, how they interpret volatility, how they value patience, how they identify asymmetric opportunities, and how they develop conviction in a noisy, emotionally charged marketplace. To unlock their secrets, one must read between the lines, absorbing the philosophy rather than the tactics, the worldview rather than the anecdotes. Because the real difference between average investors and millionaire investors is not access to special information, but the cultivation of a mindset that transforms ordinary tools into extraordinary results. At the heart of many millionaire investing books such as The Intelligent Investor, Rich Dad Poor Dad, The Millionaire Next Door, Think and Grow Rich, The Psychology of Money, One Up on Wall Street, and Common Stocks and Uncommon Profits, is the understanding that wealth grows from disciplined behavior, not dramatic moves. Millionaires do not outperform because they find magical stocks. They outperform because they avoid catastrophic mistakes, stay invested, protect downside risk, and allow compounding to do its work. One of the first secrets these books reveal is the difference between active excitement and passive mastery. Beginner investors chase action, rapid trades, market trends, news cycles, believing activity equals progress. Millionaires embrace stillness, clarity, and restraint. They understand that the greatest gains often come from long holding periods, low turnover, and boring consistency. They know that emotional stability is a financial skill. Thus, the wisdom tucked inside these books often points not to what the investor should do, but to what the investor should stop doing. Another core secret is the emphasis on asymmetric decision-making. Millionaire investors seek opportunities where the upside is significantly larger than the downside. Books by investors like Peter Lynch, Phil Fisher, and even venture-oriented writers reveal that wealth rarely comes from diversification alone, but from identifying a handful of exceptional opportunities and having the courage to bet meaningfully when the odds align. This is not gambling, it is calculated conviction built upon deep understanding. Millionaire investors read businesses like stories. They understand competitive advantage, consumer psychology, leadership quality, scalability, margins, and market shifts. They treat every investment as a long-term partnership rather than a short-term speculation. These books teach readers how to recognize hidden growth, how to think in terms of future optionality, and how to evaluate companies not by what they are today, but by what they can become over years or decades. Yet another insight is the power of compounding identity, not just compounding returns. Millionaire investing books reveal that the most successful investors evolve into people whose habits, environment, and internal narratives are aligned with wealth creation. They read consistently, think independently, avoid distractions, and cultivate emotional fortitude. They understand that financial markets reward those who can endure boredom, volatility, and uncertainty without abandoning the plan. They cultivate patience as a superpower. They internalize the difference between temporary fluctuations and long-term value. This identity shift is subtle but decisive. Without it, the investor is easily swayed. With it, the investor becomes unshakable. Another secret woven throughout these works is the emphasis on preparation over prediction. Millionaires know they cannot forecast markets with precision, so they design portfolios and strategies resilient to the unknown. They diversify wisely, allocate according to goals, build liquidity for crises, and invest with humility. Books by Benjamin Graham, Charlie Munger, Ray Dalio, and Nassim Taleb emphasize the importance of survival, staying in the game long enough for compounding to work its magic. Millionaire investors focus less on maximizing returns and more on minimizing irreversible losses. They play the long game. They value robustness over brilliance, simplicity over complexity, adaptability over arrogance. A recurring theme is the understanding that wealth is a behavior problem, not an intelligence problem. Books like The Psychology of Money expose the emotional traps that destroy wealth: panic selling, overconfidence, impatience, herd mentality, and fear-based decision-making. Millionaire investors build emotional systems, rules, habits, constraints that protect them from their own impulses. They understand that the market manipulates emotions, and they refuse to trade feelings instead of facts. They anchor decisions to principles rather than moods. They know that the mind is the true battlefield, and mastering it yields far greater returns than mastering charts or economic forecasts. Several millionaire investing books also illuminate the concept of economic ecosystems, the macro patterns, cycles, incentives, and structural forces that shape financial outcomes. Ray Dalio's works, for instance, dissect long-term debt cycles, inflation dynamics, and geopolitical shifts. These insights teach readers to contextualize investments within broader systems, recognizing that markets move not in isolation but in response to human behavior, government policy, global shifts, and technological evolution. Millionaires, therefore, think multidimensionally, connecting dots across industries, eras, and narratives. They see the bigger picture, not just price charts. Another secret is found in the emphasis on cash flow and ownership, ideas echoed in Kiyosaki's teachings as well as more traditional investment literature. Millionaires focus on acquiring assets that generate passive income businesses, dividends, rental properties, royalties, online systems. They understand that earned income has limits, but ownership does not. They prioritize leverage using other people's money, systems, or time to scale results. They distinguish liabilities from assets with emotional clarity rather than wishful thinking. They seek financial independence through streams of income rather than dependence on employment. Finally, millionaire investing books teach readers to embrace simplicity in a world addicted to complexity. The wealthy know that the most effective strategies are often shockingly simple. Spend less than you earn. Invest consistently. Buy quality assets. Think long-term. Reinvest returns. Avoid big mistakes and stay calm. Complexity seduces amateurs. Simplicity enriches professionals. The secret is not hidden knowledge. It is the discipline to follow basic principles without deviation. When all these insights intertwine: behavioral discipline, asymmetric opportunity, long-term thinking, identity transformation, system awareness, cash flow focus, and simplicity, the reader unlocks the true essence of millionaire investing wisdom. It becomes clear that wealth grows not through lottery-like outcomes, but through psychological refinement, strategic clarity, and a lifelong commitment to continuous improvement. And in understanding this, the reader steps closer to joining the ranks of those who treat money not as a mystery, but as a craft, shaping their financial destiny with intention, awareness, and the quiet confidence that emerges when the secrets of millionaire investing books finally integrate into the core of your financial identity, shaping not only how you invest, but how you perceive risk, opportunity, discipline, and the long arc of wealth creation itself. In this second phase of the exploration, the focus shifts from the thematic insights of millionaire investing books to the deeper transformations that occur when a reader truly internalizes their wisdom, how these ideas reshape cognition, behavior, and strategic awareness, and how they translate into a real-world investing philosophy that elevates an ordinary participant in the markets into a deliberate, long-term wealth builder. The first transformation happens at the level of clarity, the sharpening of mental vision. Once the lessons from books like The Intelligent Investor or The Millionaire Next Door sink in, the reader stops seeing investing as guesswork or speculation. Financial noise, market rumors, sensational headlines, short-term predictions begins to lose its grip. Instead, patterns emerge: the importance of valuation, the role of cash flow, the inevitability of cycles, the advantage of patience, the danger of emotional decision-making. This clarity simplifies the investing experience. It removes confusion and replaces it with principles. Clarity is powerful because confusion creates paralysis, but principles create confidence. The next transformation is behavioral rewiring. The core message behind The Psychology of Money. Readers begin noticing their instincts before acting on them. They recognize when they are chasing hype. They sense when fear is distorting perception. They become aware of overconfidence. This shift from emotional impulsivity to measured reflection is the dividing line between amateurism and mastery. Once behavior stabilizes, investing decisions become more rational, consistent, and aligned with long-term goals. Even more importantly, the reader begins to understand that resisting emotional temptation is not a single skill. It is the foundation upon which every other investing skill rests. Another transformation arises through opportunity calibration, a concept widely discussed in works by Peter Lynch and Phil Fisher. Millionaire investing books teach readers not to fear opportunity, but to study it, to break down business models, examine competitive advantages, analyze management integrity, and assess growth potential. The reader begins asking sharper questions. What problem does this company solve? What moat protects it? Is the market expanding? Does leadership execute consistently? They stop looking for hot tips and start building their own conviction. This recalibration shifts investing from dependence to independence. Wealth is built not by copying others, but by learning to see clearly. The next transformation is time horizon expansion. Millionaire investors, as portrayed in books across generations, think in terms of decades rather than days. When readers adopt this lens, their stress decreases, their conviction strengthens, and their results improve. They embrace the reality that volatility is the price of admission for long-term growth. They no longer panic during downturns, they prepare. They no longer chase spikes, they accumulate value. Time becomes an ally rather than an adversary. When long-term thinking becomes second nature, compounding begins to accelerate, not merely mathematically, but psychologically, because consistency becomes easier to maintain. Another profound shift occurs through identity elevation. The reader no longer sees themselves as someone who hopes investments will work out, but as someone capable of analyzing, selecting, and holding assets intelligently. Identity influences action. When the reader adopts the identity of a disciplined investor, they protect their portfolio from impulsive choices. When they adopt the identity of a patient wealth builder, they avoid unnecessary trading. When they adopt the identity of someone who expects long-term success, their behavior aligns with that expectation. Millionaire investing books, at their core, are identity manuals disguised as financial guides. A further transformation emerges from risk refinement, an idea emphasized in value investing, behavioral economics, and probabilistic thinking. Readers begin to distinguish acceptable risk, avoidable risk, and asymmetric risk. Acceptable risk is volatility that accompanies long-term growth. Avoidable risk is speculation, leverage without margin of safety, or emotional decision-making. Asymmetric risk is opportunity, where the potential gain exceeds potential loss. This categorization changes everything. Mistakes become less frequent. Opportunities become clearer. Decisions become less emotional and more calculated. Risk becomes a strategic tool rather than a source of fear. One of the subtle but powerful evolutions that millionaire investing books trigger is the abandonment of complexity worship. New investors often believe that sophisticated strategies signal intelligence, but advanced readers discover the opposite. Simplicity, executed with discipline, outperforms complexity, executed inconsistently. The wealthy gravitate toward elegant solutions, index funds, high-quality companies, durable cash flow assets, because simplicity survives chaos. Having fewer moving parts means fewer points of failure. The investor becomes less busy and more effective. As the reader evolves, they enter the realm of structural wealth building, integrating lessons from Kiyosaki, Graham, Taleb, and Dalio into a cohesive system. Structural wealth involves automatic investing, thoughtful diversification, liquidity reserves, consistent cash flow assets, tax-efficient planning, and a long-term portfolio that reflects life goals. Structure creates resilience. It ensures that wealth grows even when attention wavers. It protects against panic. It makes the investing journey calm rather than chaotic. This structural lens is the true hallmark of millionaire thinking. Wealth is not a project. It is a design system that operates continuously. Eventually, a deeper philosophical transformation emerges. The investor stops trying to outperform others and begins focusing solely on outgrowing their former self. Millionaire investing books subtly guide readers toward internal competition. The goal of investing becomes progress, not comparison. This removes ego, which is one of the most destructive forces in markets. When ego dissolves, clarity improves. When clarity improves, decisions become cleaner. When decisions become cleaner, returns stabilize. As these transformations integrate, the reader begins to understand the ultimate secret hidden within all millionaire investing books. Wealth is not the result of extraordinary intelligence, but extraordinary consistency. The true mastery is staying on course when others quit, continuing to invest when others panic, holding quality assets when others get bored, and learning continuously when others stagnate. Consistency is the real unfair advantage. And finally, the reader arrives at the most profound realization of all. Investing is not just a financial activity. It is a personal evolution. Each stage of the journey mirrors an internal transformation, from fear to discipline, from confusion to clarity, from insecurity to conviction, from imitation to independence, and from scarcity to possibility. Investing becomes a mirror reflecting who you are becoming. Wealth becomes a byproduct of internal growth. And the secrets of millionaire investing books reveal themselves not through intellectual reading, but through the lived experience of a person who has absorbed their wisdom deeply enough to act with intention, resilience, and unwavering patience. Completed.